We're going to look at Hannon Armstrong. This is a REIT that focuses on companies in renewable energy. And what I do in my videos is I use my discounted cash flow model to figure out the intrinsic value of the company, the actual value of the stock. And I also look at the financial ratios and compare them to similar companies. And I'm going to do this with you throughout the video, so it's like we're doing the whole process together. So let's get started with the model. This company has a market cap of $2.13 billion. And let's get their stock price. That's $29.38. So one share is about $29. Now I'm going to pull the free cash flow, and this is the cash that's remaining after a company pays its expenses. And I'll put that into the model. Now I'm going to pull the net income on the income statement, and this is the profit and loss for the company. And we also need the revenue, which is on the income statement, and that's the sales for the company. And the sales are just the rent and lease payments. And as you can see, the numbers look pretty good. They're all positive and fairly consistent. And it looks like the net profit margins have been increasing each year. Net profit margin is income over revenue. It's how well a company converts its revenue to profit. So they're becoming more efficient. They went from 35% to 58%. Let's look at the capital structure so we know what to discount the future cash flows by. Let's get the interest expense. That's the interest this company pays on its debt. That's $62 million. And they have debt of $1.4 billion. So the interest rate is 4.6%, and that's their cost of debt. Let's get the cost of equity. We need the beta for that, and that's how much the stock moves relative to the entire market. So they have a beta of 1.52. So the stock moves roughly 1.5 times the market. So if the market went up 10% over the course of a few months, this stock should go up 15%. And if the market went down 10%, this stock should go down 15%. Let's get some more information from the balance sheet. We need their equity. That's total assets minus total liabilities. And that's $936 million. And I pulled their current assets, that's $1.4 billion. They don't have any current liabilities. Let's get their earnings before interest and taxes. We'll go to the income statement. So we have to calculate it. It's going to be total revenue minus operating expenses. So with $141 million minus the $51 million, and that's going to be the EBIT, or operating income, $90 million. That's how much money the company makes from its operational business, but before it pays interest on its debt and before it pays taxes. So let's look at their capital structure. They have 60% debt, and the cost of debt is 4.6%. And they have 40% equity, and the cost of equity is 14%. And we figure that out using the capital asset pricing model. So the weighted average cost of capital is a combination of the cost of debt and the cost of equity, 8.4%. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. Then we also did a terminal value, which is all years past year 4. We discounted those numbers back to today, and we get a value of the entire company of $874 million. We divide that by 72 million shares, and we get a calculated intrinsic stock price of $12. That's how much I value the company today, at $12 a share. They're trading at $29 a share, so they're trading at 144% premium. They're a sell according to my model. Let's see what Simply Wall Street values the company at. They're valuing them a little higher at $16 a share compared to my $12 a share. But both cases, both models are saying the company's a sell. It's overvalued. Let's look at the historical stock price. And it looks like it's been trading even higher. A few months ago it was trading closer to $33, $34. It did drop a lot at coronavirus, but it's come back up. So investors are willing to pay $28 a share. So they see the future outlook of the company better than the financials indicate. Let's look at their financial ratios. So they have a PE of 26. That's a little high. I prefer under 15. That's price to stock over earnings per share. They have a high price to sales ratio. I prefer under 3. They have 15. That's price to stock over sales per share. They have a good price to book. I like to see under 3. They're 2.3. That's price to stock over book value per share. They don't have a current ratio because they don't have any current liabilities. ROE is pretty low at 9%. I like to see about 20%. That's net income over equity. Interest coverage ratio 1.4, so they can only cover their interest payments 1.5 times. That's not much of a cushion. And they have debt of 60%. And the best ways to look at ratios is to compare them to similar companies. I've done videos on American Tower and Power REIT, which are in the same industry as Hannon Armstrong. And if Hannon has a number in green, they're better than the average. And if they're in red, they're worse than the average. And if a number is in orange, that means they're the best in that category out of the 3 companies. So they have the best PE, the best price to sales, and the best price to book. American Tower has the best ROE. The other 2 are pretty weak in that category. All companies have a decent amount of debt. American Tower has the most. Hannon Armstrong has the least. And American Tower is a giant of a company. The other 2 are pretty small compared to them. So let me know what you think in the video. I hope you enjoyed it. Thanks for watching.